Good morning or good afternoon, everyone, depending on where you're joining from. I know we're right at the start time. I'm just going to wait another minute or so to see who else is going to join, and then we'll be off to the races. All right, so we waited a couple minutes. I'm sure people will be popping on as they are available to do so. So I think we'll get started. Welcome, everyone. Thank you for joining today. I'm Mike Brown, the CEO of Brightline CPA. And today we're going to talk about where your money is. It's a common problem in business, more common than you'd think. I talk to clients a lot about it, so I figured why not put on something to spread the word. So before we get started, just to get a feel for who's in the audience today, Jacob, do you maybe want to run the first poll just to see what kind of business everybody runs here?
Yep, here we go. Should be up now.
Awesome. Thanks, Jacob. If everybody can just type in what type of business they run, that would be great. We've got a shy crowd today. Okay. No one feels like sharing today. Um, all right. Well, Jacob, maybe we'll just leave that open for another minute as people are coming in. They can add some responses to that. But otherwise, I'm going to get started just outlining the agenda and what we're going to talk about today. So, um, thank you everybody for joining. So, we're here to talk about profitability. We're here to talk about cash flow. There's often a disconnect between the two. I see it a lot with the clients that I work with. So I figure it's probably good to talk a little bit about that today. So we'll start, obviously, an introduction to me, to my firm, Brightline CPA. We'll break down the problem in a bit of detail. So we'll define profitability, we'll define cash. That seems kind of redundant, but we'll go through the definitions. We'll understand the problem. That's the most important step to any troubleshooting. And then we'll talk about some of the stuff that I see most commonly amongst my client base, mistakes that I see people make when it comes to cash flow. We'll give some solutions as well. So we'll talk a bit about how to get a handle on the cash flow in your business. And then, of course, we'll have a Q&A at the end. On that note, I've got my team member, Jacob, here with me. He is going to be monitoring the Q&A section. So throughout the webinar, feel free. There's a little Q&A button in the top. If you're using the web version of Teams, there should be a bar on the top. You'll see a little Q&A icon. It's got a question mark and a chat bubble. Anytime you have any questions throughout, you can put them in there. Jacob will be monitoring that and stopping you when appropriate to answer your questions. But of course, there'll be some time at the end as well. So just a little bit about who I am and who we, Brightline CPA, are. So my name is Mike Brown. I am one of the co-founders of Brightline. We started the firm just about 4 years ago in August of 2021. My partner and I were both working for a larger accounting firm in the Halifax area. and just kind of figured it would be nice to go out and do our own thing, to get out of the traditional accounting firm model. So we really wanted to serve clients in a better way, in a different way than what we were doing before. And so we thought the best way to do that was to strike out on our own. So when we started Brightline, we were just doing what everybody else was doing, which is filing tax returns. But now we are in a different business model that's more focused around bookkeeping and financial reporting and controllership services. So I find that our clients really benefit from a nice marriage of accounting services, so your year-end CPA stuff, and bookkeeping services, so the day-to-day kind of data entry and financial data. So there's a lot of benefits from having those two things under one roof, and that's what we offer to our client group. We also do a lot of different touch points throughout the year, making sure we're not just talking to you once a year. And obviously, given that this is our first webinar and the topic of it is cash flow, we're very focused on providing a lot of information to our clients about the financial health of their business and how their cash flow is doing, most importantly. Because as I'm sure you know, in running a business, cash is very important and you need to have some. So let's dive right into the problem. So it seems pretty straightforward. You're running your business. You're getting maybe an income statement from your accountant every so often, or your bookkeeper, and it shows that you have a profitable business. So that should mean that you are making money. But then the balance in your bank account is not increasing by the same amount that you're showing profit, or your bank balance is actually going down. So why is that? If you're just looking at your bank account and running your business that way, obviously you'll have a good handle on how much money you have in your account, but you're not really sure, like, is my business profitable? Am I making money off of the work that I'm doing? Or is money coming in the door and my expenses are higher? So looking at your bank balance is not the right way to run your business, especially as it grows and becomes more complex. There's often a disconnect between these two things. For example, I just want to share a quick client story. So I started working with a professional services firm, and they were making about $2.5 million of revenue each year. When we looked at their income statement, their top line obviously showed 2.5 million. And then as we go through and take off your expenses and all of that good stuff, the net income number at the bottom was showing 300,000. So pretty good business, was making quite a bit of money every year, which should indicate financial health, right? But then when we flip and look at the balance sheet, we actually saw that the business was heavily into their overdraft. And as time went on, even though throughout the last year they had shown 300,000 of profit, their bank balance decreased by $5,000, or I should say their overdraft increased by $5,000. Why is that? They were showing that they were making a profit, and profitability means I'm making money. So why wasn't money going into the bank account? It's a pretty common pain point, honestly. It's something I see a lot, especially when I first start working with clients. They don't really know why there's a disconnect between the two numbers, and that's part of what we do in the initial stages of working together. Is we try to troubleshoot that. So as time goes on, hopefully we can get a handle on that. So I think we'll try again and see if everybody's shy. Jacob, do you maybe want to launch the second poll? I just want to find out if people here have talked to their accountant or bookkeeper recently about cash flow. So you should see the poll pop up. Maybe you have, and it was really helpful, and you understood what they were talking about. Maybe you did, but you had the discussion and it really didn't make sense. Or maybe you just haven't talked to them about it. So we'll give people a second to submit a response to that. All right, so far it looks like people haven't been talking to their accountant or bookkeeper about cash flow. Okay, another no. All right. Well, that gives me a good sense of what everybody is talking to their accountant and bookkeeper about. You can go ahead and close that poll, Jacob. So that's not really surprising to me. It looks like everybody who voted for no. Um, so I find that typically, and I'm sure this will sound familiar, but when you're talking with your accountant or your bookkeeper, whether it's monthly or quarterly or even just once a year, it's very likely that they're talking to you about your income statement. So you've probably seen that before. It shows the amount of revenue, all your expenses, and then a net income number at the bottom. That's probably it. Maybe you look at a couple other reports, but generally that's the one report you're looking at and one indicator. And typically the one indicator that they focus on is profit. Here's the problem with profit. It's just theory. There's a lot of things in the accounting world that can impact profit. So if you've looked at your financial statements in some detail before, you'll see some stuff in there that I kind of call accounting nonsense, which can be, for example, amortization on capital assets. That's not really an expense. That's not cash leaving your business. Obviously, you've invested in equipment or a building or whatever, but it's not leaving your bank account every month, but the amortization expense is still coming up. So profit is really just theory. There are obviously some good things we can learn from looking at an income statement and looking at profit, but cash is reality. Cash coming in the door is the lifeblood of your business, and cash going out the door is how you pay your bills, pay your employees. So the movement of cash is the day to day in your business. And I'm sure you've heard this before. It's a very common saying in entrepreneurial circles, but cash is king. You can, as I shared with you earlier, have a profitable business, but if cash isn't coming in the door, you might have problems paying people, and then you don't have a business. So that's why we really want to focus on cash and cash flow when we're looking at financial health in a business. So we'll start by defining what profit actually is, because I mentioned that it is important that we look at it, but it's not important on the day-to-day when we're looking at cash fluctuations. So profit is, will my business make money in the long run? So if you think about looking at, let's say, a year, if we're looking over the span of a year, we want to make sure that there's profit being generated by the business. Why? Because it means that overall, the amount of money we're charging for the thing that we do is more than our expenses. So that's a good thing. It means we're not going to lose money in the long run. So we care about profit, but here's where the disconnect comes in. Let's say you sell something and you charge $10,000 for that thing. But then you have to pay, whether it's employees or subcontractors, or if you're selling goods, maybe you have to buy some stuff to make those goods. Let's say you pay $5,000. If we look at our income statement, it shows we have $5,000 of profit. But the disconnect comes in with real life. Do your customers pay your invoice on time every time? Or is there sometimes a wait? Maybe that wait is only a couple days, maybe it's a month, maybe it's longer than a month. When you get a bill from your suppliers, do you pay that right away the second it hits your inbox? Probably not. You probably wait a bit of time. Again, whether it's a couple days or a couple weeks or a month. But you don't necessarily pay things on time, and neither do your customers. So we can have, if we were looking, let's drill down to a smaller period of time. If we're looking at a month and we've got $5,000 of profit, that doesn't mean that our bank account went up $5,000, because real life happens and people take time to pay things. So that's why I say profit does not equal cash. When we look at cash, or when we're talking about cash flow more specifically, we're looking at money moving into our bank accounts and money moving out of our bank accounts. And the net of that is cash flow. So where profit is really focused on our long-term health of the business, am I going to make money over the next year, 2 years, whatever? Cash flow is really looking at smaller time periods. We're looking at days or weeks or months. And we want to make sure that our net cash flow is positive, because it means that the business is not only profitable, but it is generating cash. And we want to generate extra cash so we can reinvest it in our business, so we can make money as business owners. and so that we have, a nice healthy business that maybe somebody want to buy someday, or maybe we can, take some money and invest it in other things like real estate or whatever. But that's why we're focusing on cash flow here. So remember, if you bill your customers $10,000 and you get $5,000 of supplier bills in return, you've got a net profit of $5,000. So going back to that example, let's say none of your customers pay you, even though you earned $5,000 of profit. If nobody paid you and you paid your suppliers because you're a good customer and you want to make sure that people get paid on time, you've paid out $5,000, but you've got nothing in. So you actually have negative cash flow of $5,000, even though your income statement says I made a profit. So that's why when we're looking at accounting financial statements, we sometimes need to dig a bit deeper because they don't always tell the full story. Sure, looking at your financial statements is important, but often doesn't paint the full picture. And so we need to look at other things on a more frequent basis to make sure that we've got a handle on that cash flow. So Jacob, maybe I can get you to launch the third poll, because we've talked a lot about an income statement. So I just want to know, what financial statements does your accountant or your bookkeeper review with you? It could be that it's just an income statement. You could get a balance sheet in there as well. You could also have a cash flow statement, or maybe all of those, and maybe there's additional reports that you're looking at. So I just want to get a sense of that. All right, it looks like we're, excuse me, it looks like we're pretty evenly split right now. We've got some people looking at just an income statement. We've got some people looking at an income statement and a balance sheet, and some that are looking at cash flow as well. Okay, so that's pretty typical. I would say that most people, when they're talking to their accountant or they're talking to their bookkeeper, they're maybe looking at an income statement. Maybe they look at a balance sheet as well. It's not very often that people go beyond that. Thanks, Jacob. You can close that poll down now. So the reason I wanted to know what everybody's looking at with their accountants or with their bookkeepers is because I find if we're looking at the disconnect between profit and cash, let's talk a little bit about why certain items on our income statement don't equal cash in our bank accounts. So the disconnect will often come from, we kind of talked about this already, delays in invoicing. So maybe you didn't invoice your customer fast enough. More commonly, I find it's people are just slow to pay. That would be collecting your accounts receivable. So that's often a disconnect between profit and cash. We might have purchasing more inventory than we need. So if you run a business based on buying and selling goods, let's say you buy a ton of inventory, but it takes you a number of months to sell that. So you've had a big upfront investment of inventory. That could be a disconnect. Maybe we're buying expensive stuff. We're buying a new truck. We're buying a building. We're buying an expensive piece of machinery. Then there's taxes. I'm sure everybody who runs a business is familiar with paying the CRA, probably more than they think they should. Paying your sales tax installments, paying your corporate income tax or your personal income tax at the end of the year. Then we have paying down debt. Maybe to do one of the things above, you had to take out a bank loan, and you were paying that down every month per your repayment terms. And then maybe you're taking, if you're an incorporated business, maybe you're taking money out of that business, but you're not taking it as a salary. So you don't have yourself on payroll. You're just kind of taking cash as it comes in. These are all things that create a disconnect between profit and cash. And again, the reason I wanted to ask about what financial statements you're looking at with your accountants or your bookkeepers is the thing that kind of ties all of these items together is they all live on our balance sheet. So the balance sheet's a little confusing because it has a lot of what I call accounting nonsense on it, especially if you're into a world of what's called accrual accounting. And I'm not here to teach you an accounting crash course or accounting theory 101. But basically, the balance sheet gets glossed over because when we're looking at an income statement, it's pretty easy to understand revenue, which is technically money in, expenses, which is technically money out, and net income, which is the net I have after money comes in and then money goes back out. Balance sheet is a bit harder to understand, and so I find that people often gloss over it. But it is important, as you can see, when we're talking about cash flow, because the stuff that disconnects cash from profit all lives on the balance sheet. So speaking of cash flow, I think let's actually start to put some definitions around it, because so far we've been talking about it vaguely as, cash going into our bank account. But there's a couple of different ways that I like to look at cash flow. So when we run cash flow reports for clients, we're looking at three main indicators, which are on the slides here, and we'll just talk through. So we start with operating cash flow. And this is really should be the bulk of the cash that's coming into your business's bank account. It's the cash that you generate from the stuff that you do. So if you are in the business of, let's say, real estate, you help people buy homes or sell homes. That would be the cash that comes into your bank account from you doing that activity. Let's say you own a coffee shop. That would be the cash generated from slinging coffees to people all day. It's the money that you make from doing the thing that your business does. That's our operating cash flow. So if we look at our operating cash flow and it's positive, that means that our business is generating cash. We're earning more money than we're spending. That's great. Next, if we've got a positive operating cash flow, it means, as I said, we're making money from the thing we do. And now maybe we want to reinvest that money. So if, I run an accounting firm, I sell accounting services. If I have a positive cash flow from selling accounting services, what would I do with that extra cash? Maybe I'll take that out for myself as an owner. That's fine. But maybe I want to reinvest that back in my business. So maybe I want to buy new computers, or maybe I want to hire a new employee or something like that. Basically, what I have after I pay all my regular suppliers and stuff is my operating cash flow. And then after I reinvest in the business, that's my free cash flow. So that is, I've run my business. I've now reinvested in growth. I've got some cash left over. That's free to do with what I want. And then finally, we have net cash flow. And that can be pretty much depending on the type of business. If you run a services-based business, it might be the same as free cash flow. But net cash flow is really your bottom line when it comes to cash. It's the fluctuation in your bank account month over month is really the net cash flow. And the reason that we like to break it out into chunks is troubleshooting, basically. So if we're looking at cash and cash is going down, if we're looking at just the bank balance, if we think that's a problem, and generally it is, if you're losing cash month over month, if we want to troubleshoot that problem, we need to figure out where the issue is. So if we have a positive operating cash flow, but we have a negative free cash flow, then we know that the issue doesn't lie in the way that we run our business from an operational standpoint. So if I have a positive operating cash flow from selling accounting services, it means I'm not concerned about maybe a pricing issue or a labor productivity issue. That is positive, so I'm okay with that. What it could mean is that I've invested too heavily in growth. Maybe I've spent too much money on computers that year, or maybe I have too much debt and the debt repayments are more than the cash flow I'm generating from my accounting firm. So, there's different reasons why we'd want to split these out and look at them separately. And really, it comes down to understanding where problems lie and being able to fix them. So as I'm talking to my clients month over month, I'm talking a lot about cash flow, and I see a lot of mistakes when it comes to how we treat cash flow in our businesses. So I thought I'd share the 5 most common ones that I see and talk a little bit about those. So number one, Obviously, as an accountant, I'm a bit biased, but looking at financial statements regularly is very important to understanding um, the health of your business and also, the cash flow situation of the business. So if you're not reviewing financial statements regularly, that could be a mistake you're making, the cash flow in your business. So like I talked about on the last slide, diagnosing the problem is often the first step in trying to understand cash flow issues, and we can't do that if we're not looking at good financial information. So, of course, we want to look at our income statement. We want to see if we're going to make money in the long term, if we're running a profitable business model. We also want to look at the balance sheet. I know it can be a bit more confusing to look at, but hopefully with a good accountant or bookkeeper, they can explain the highlights to you and explain some of what is going on there. For example, some of the things we look at on the balance sheet are accounts receivable. That's the money that your customers owe you. So are those being collected quickly? We can tell by tracking the balance month over month. If it's going up, it means that we're billing our customers, but they're just not paying us fast enough. So we can look at that. We can look at the ratio of cash that we have to maybe debt that we have or accounts payable that we have. So there's a lot of good stuff on the balance sheet we can look at to determine financial health and also to kind of like paint a picture cash flow. If we're looking at financial information regularly, we can start tracking certain metrics that will help us undertake major business decisions. So, for example, if we're not looking at our financial statements and we're just looking at our bank balance, how do we know if we can afford to hire a new employee? How do we know if we can afford to buy a new piece of equipment or make a major purchasing decision? If we're just looking at cash in the bank, it can be really tough to tell if we can actually afford to do that thing. And that's where looking at financial information comes in. Number two, I probably talk to my clients about this the most out of anything when I'm doing monthly reporting for my clients. I find that 9 times out of 10, I am talking to them about either invoicing or collecting from their customers. So the problem with a lot of clients, especially the ones that I work with, which tend to be, there's a lot that are in the construction industry. They do monthly billing, and they do monthly billing based on the expenses that they incur on projects. So if they don't bill fast enough, it means that their customers aren't going to pay them quickly, especially in construction. It can take 30 plus days to get paid by a customer. So if you're not billing right at the start of a new month, you're delaying that even further. But guess what? You've already paid those expenses. That's cash out the door. So you're effectively making loans to your customers if you're doing that. So billing on time is important, and making sure that you're collecting from your customers quickly is important. I find the best way to ensure that that's happening is to have a formal system or a formal process. And that doesn't have to be anything fancy. You don't need to invest a ton of money or time and effort into this. It can be as simple as setting, the first or the second day of the month, put a 4-hour block in your calendar and say, I'm taking half a day and I'm invoicing my customers. That could be the start of your billing system. Collection system. I mean, software can help you with a lot of this stuff. You could have auto invoices going out. Like, let's say if you're on a fixed fee agreement with a customer, you could have a platform that allows you to just charge that automatically. It could also send follow-ups automatically so that it's reminding them to pay the invoice. There's a lot of different platforms that you can use to help with a good chunk of the heavy lifting for point number 2 here. Because not following up with your customers and just letting them pay whenever they want can be damaging to your business, especially if they're taking a very, very, very long time. And there's some stuff that you can do to incentivize faster payment. You can make it easier for people. I know we use a platform that allows people to put in a credit card or create a pre-authorized debit agreement. We do fixed fee engagements. So if it's, let's say $1,000 a month, every month on the same date, it pulls from the payment method on file. There's no issues around that. It's easy for the customer to pay me, so I don't really have an issue with collections on that front. You could, depending on your business, and if it makes sense, you could offer an early payment discount. So that could be, 1% discount on the invoice if they pay within 7 days or something, just to incentivize getting cash in the door faster. So there's a lot of things that you can put into your billing and collections process. It just depends on you and your customers and the type of business that you run. Third mistake that I see most commonly is a focus on revenue and not margin. So again, I'm not going to get too deep into accounting theory here, but revenue is the amount of money that your customer pays you. So if I sell you an accounting service for $100 and you pay me $100, I've got $100 of revenue. But of course, to deliver that service, I have costs. So I have to pay myself or my employees. I have software costs. I'm paying for computer equipment, insurance, all of these things. And so what I have to do when I'm looking at the amount of money that's coming in the door is I have to look at, am I making money on it? Because I could have $100 come in revenue, but let's say I pay my employees $150 to deliver the service, I'm actually losing money. And that amount of revenue over the amount of cost to deliver on something is called my margin. So if I see this a lot with solopreneurs, people just working for themselves, and they don't have employees or subcontractors or whatever. We're just looking to get money in the door, right? So we have a potential new client. They're interested in something that we can do for them. They will agree on a price, and the price is sometimes just pulled out of thin air. I think, yeah, I can do this for $1,000 a month. And then that's the end of it. And then you work and work and work to deliver that service. But maybe you're working more time than $1,000. Maybe based on how much you value your time at, you're working $3,000 worth of time. So yeah, we've got money coming in the door, but we're not actually making money off it. And so part of the issue I find in managing cash flow or managing a profitable business is focusing on that top line, but not focusing enough on the margin that a project or a customer or a sale will actually bring in the door. Number four, ignoring upcoming obligations. So when we're looking at our bank account, or even if we're looking at a profit and loss, we're getting a sense of what's happening and how much cash is available. But if you look at your bank account and see $10,000, you might think, okay, I've got $10,000 that I can spend. But maybe next week you've got to make a payroll remittance, and that's $2,000 or $3,000, or maybe your corporate tax bill is coming up. For those of you that are incorporated, that should have been paid a couple of months ago, but maybe that bill is coming due. So maybe you've got $10,000 sitting in your bank account, but it actually is going to go out the door in a short period of time. So making sure that you're focused on those things that are recurring or are going to come up, that can be an important step in making sure that you've got a business that is generating cash. So I see that a lot. CRA requires either monthly or quarterly installments on income tax and HST if you're paying more than a certain amount of those taxes. And if you're not making those installments, you might be accumulating cash over the year, but come year end, you're supposed to owe them $20,000 or so, and if you've only got $10,000 in your bank account, you're in trouble. So making sure that you're looking forward instead of just backwards, and factoring in those other things that come up that don't live on the profit and loss, they live on the balance sheet. I would say that is one of the more common things I see. And it can be solved with some light forecasting, which can be complicated, but can also be a fairly simple exercise, especially if it's just a tax liability, or maybe it's a debt that you pay monthly. Just trying to model that out so like, okay, if I have that monthly payment, it comes out on the 15th of the month. I've got $5,000 in my bank account now. You kind of know what you need on that date the loan payment comes out to have in your bank account. And you can start. That's a very simple way to start some very simple forecasting. And then finally, this one I see pretty regularly. It's something that is a little bit counterintuitive sometimes, but everybody wants to be a good customer because we want good customers. So if I want my customers to pay me on time because I have to pay my employees and pay my debt and whatever, if I'm working with somebody and they send me an invoice, I know what that feels like to not be paid on time. So I want to pay right away. But making sure that you pay the second you receive a supplier invoice is also a good way to make sure that you're going to have cash flow problems, because it could be that there's payment terms attached to that. So let's say maybe your supplier only requires payment within 14 days. If you pay right away, it's no skin off their back. Obviously, they like when people pay right away. But if you pay in 13 days, that is within their acceptable range of accepting payment. If their payment terms are 14 days and you pay in 13, they're still happy. So you haven't damaged supplier relationships. You haven't incurred any late payment penalties. You haven't incurred any late payment interest. So everything is still fine on that particular supplier. But what's happened is maybe you have paid that supplier too early and now you can't make a loan payment, or now you can't make payroll, or now you can't pay your payroll tax to CRA. So the timing of cash coming into and out of your business is important, and making sure that you're not paying all of your supplier invoices right away is key to making sure that you've got cash to fund obligations as they become a priority. So I would say like those five are probably the most common that I see. I would say number two is one that I see across almost every single client I work with. They don't really have a process for invoicing and collections. It's where I spend a lot of time working with people, and it's a pretty, I would say, pretty immediate impact on cash flow to focus on number two. Number five, also quite easy to implement, very easy to wrap your head around. And honestly, a lot of this stuff can be managed with software. There's a ton of really great tools out there today. Some of my favorites are we use Pluto quite a lot. That's Plooto. It's a platform that will collect money from your customers and also pay bills. So it integrates with a bank account or a credit card. It's really nice because it plugs into your QuickBooks or your Xero file. So if you are putting supplier invoices or customer invoices into QuickBooks or into Xero, Pluto will snag them automatically. It'll know when they're supposed to be due, and it'll send out reminders, collect payment, process payment, all of that stuff. So I like that one. Dext is another one, DEXT. For those of you who've been in business for a while, it used to be called Receipt Bank. So you might know it as that. They've started getting some bill pay features put in there. And then another one is called Float. That's a Canadian company, actually. They do virtual credit cards, but are also launching like a bill pay platform. So there's a ton of tools out there that can help you manage these kind of things. So those are the five most common mistakes I see, and I'm sure some of you can relate to those ones there. So we've talked about the problem. Profit doesn't equal cash. We've talked a little bit about what cash flow is, where the disconnect lies. I've shared a couple of the most common mistakes that I see. And now you're probably all wondering, well, that's great, but how do we fix it? So when we're looking at how to get our cash flow under control, the first thing that we want to do is identify the problem, which sounds straightforward, but going back to a couple of the slides that we've looked at, if we don't understand what the problem is and we don't have good data to help us diagnose the problem, then there's no way that we're going to get our cash flow under control. So one of the analogies I like to use on this is going to the doctor. Let's say your knee hurts and you go to the doctor and you say, my knee hurts. The doctor doesn't just, well, hopefully doesn't just do this. They don't just prescribe you something and say, great, this will help with your knee, away you go. I mean, sometimes they do, but that's just the state of our healthcare system. But theoretically, what should happen is follow-up questions. Why is your knee hurting? Did you do anything strenuous lately? Have you increased your physical activity? Have you changed your diet? All of these questions, will help somebody narrow in on the problem, and then they can prescribe a treatment. So um, there's a reason that doctors use that methodology when they're trying to figure out how to fix the problem, is because they want to make sure they're fixing the problem at its source and not just the symptoms of the problem. So if we take that and apply it to cash flow, if we say my cash flow is negative, i.e., money is leaving my bank account faster than it's coming in, well, a solution to that could be get a bank loan. So I go to the bank, I get a $10,000 loan. Great. Now I've got $10,000 of cash in my bank account. Problem solved, right? But if the underlying problem is the way that you run your business, that $10,000 of cash is going to be gone soon enough. And then you're back in the same boat. So tackling the problem at its root is important. And to do that, we need to identify the problem. So monthly financial reports, not just looking at the income statement, but looking at the balance sheet, really focusing in on cash flow as well and how that changes month over month. That's going to be the first step. We talked about the different layers of cash flow. So operating, free, and net, looking at the three of those, seeing which one is negative, why is it negative? That all helps us understand what the problem is. And then we can look at implementing solutions, which is step number 2. So some of the solutions we'd recommend, we talked about on the last slide. So it could be as simple as just following up with clients every 5 days to make sure that they're paying us. It could be setting some time at the beginning of a month to bill our customers on time. It could be putting a software in place like Pluto that will automatically follow up with our customers and collect their payments and put it in our bank accounts. It could mean using Pluto to pay our supplier invoices and not pay them until they're actually due instead of right away. These are solutions that we can implement and will help us get a better grasp on our cash flow. But of course, when we implement these solutions, we need to make sure that they're working. So I could say, well, it looks like the problem is you aren't collecting your invoices fast enough. Let's put a software in place and great, now we're collecting invoices, right? But sometimes, as we know, technology fails us and there might be some issues with that. There could be some other issues, who knows? But it could be that putting in the software doesn't result in faster collections time. And the only way that we know that is by actually monitoring the results. So step number 3 in getting our cash flow under control is actually looking at whether the solutions we've implemented have provided us with the results we want. And the way that we understand if something is giving us the results we want is we have to define what those results are. So for example, you'll hear a lot of accountants or controllers, CFOs, people online giving finance advice. You'll often hear the word KPI, key performance indicator. And I know a lot of people really struggle with KPIs because there's this belief that they need to be complicated metrics and a ton of different metrics and just a very complex system. But really, a KPI can be something as simple as, if we're going to focus on the example of customers paying us on time, a KPI could be how many days does it take my customers to pay me? And that could be the metric that we use. So let's say we implement a software or maybe a process to bill and collect faster. Let's set a target. Let's say I want all my customers to pay me within 30 days. Well, if we're not tracking the number of days that it takes for people to pay us, then we don't know if we're hitting that metric. So we have to track it and monitor the results. And if we're under the 30 days, great. Maybe we set a new target and it's 25 days. But if it's higher than our target, we need to take some more corrective action. So monitoring the results is important, and making sure that we're getting the results that we want is one of the best ways to ensure our cash flow stays under control. And finally, just look forward instead of backwards. Having good accounting data is great. Obviously, I'm biased on that, but it helps us make a lot of different decisions within our business, and it helps us understand where problems are. But accounting is all historical. You're never getting accounting information in advance of a month because that would be impossible. It's all backward looking, and that's fine. There's a lot of information we can get from information in the past. History repeats itself. is a very common saying, and that holds true in business and accounting. However, what we want to do is start looking forward. So remember back on the previous slide, the five most common mistakes that I see with cash flow, people aren't anticipating their upcoming obligations. Well, of course, how would you do that if you're always looking backwards? So we go through an exercise of budgeting or forecasting to start looking forward. And if you've ever gone through that exercise before, you know that it's not just a one and done. Building a forecast it can be complex. They're ever evolving. They need constant work and maintenance, but eventually over time, you'll have something that really helps you understand how cash is moving in your business. And then you can get a solid grip on those important questions. Can I afford to hire an expensive new employee? Do I need to go and get a line of credit to cover some cash flow crunches? Can I afford to buy a building for my business to operate out of? Using budgeting and using forecasting, which are both forward-looking tools, can help you with making those decisions. So those are the best ways I know how to get cash flow under control, and certainly it follows the same process as a doctor would follow for diagnosing and treating an issue. So if you're looking at your cash flow and wondering how to get it all fixed up, think of yourselves as a financial doctor trying to improve not just the symptoms, but the root cause of the problem. Of course, I've got to do a plug for Brightline. I work with clients a lot on monthly reporting. We have a focus on cash flow. We do some custom reporting for clients that we work to further customize over the length of our relationship. So we're always putting information in there that will be relevant to them in particular, not just a general set of reports. We do a video review of our reports. So we record a 10 to 20-minute video walking through the reports. I focus a lot on the 5 common mistakes that we talked about a few slides ago. So a lot of my clients, I'm really drilling in on billing and accounts receivable collection and all of that good stuff. But certainly the point of our service is to be different than an accountant that talks to you once a year and gives you your tax return. We really want to be focused on helping you improve financial health. And the only way to do that is to have regular recurring touch points based on great information. So we do all of that stuff. There's a couple links here. I'm going to share the slide deck after the webinar along with the recording, obviously. You can click the link there. You can see a demo of our monthly reports as well as a demo of the video review that you would get. Those things are obviously all very helpful. If you're interested in chatting more on our website or in the slide here, there's a link to our discovery forum. That's the best way to get things started. Somebody from the team will reach out, probably me, and just talk about how we can help you with that stuff. So that's everything I've got to cover today. Hopefully you guys have found that helpful. If there's any questions, now is certainly the time to ask them. So I can probably answer them for you now. Jacob, are there any questions in the Q&A section there?
No, we're looking clear for now.
Perfect. Give it a second if anybody wants to chuck a question in there. I'm going to assume nothing's come in yet, Jacob.
Yep.
Okay. Well, that's fine. Hopefully that means that everything else was very thoroughly explained. But really appreciate you guys coming out for the first of Brightline's webinars. Certainly, if you do have any questions, feel free to reach out to our team. You can submit a contact form on our website. That's the best way to get in touch. And also, we'll be sending, like I said, the recording and the slide deck. So that you can reply to our info email if there's any questions, and that'll get triaged over to me. A couple key takeaways from today. If you're going to remember anything, remember profit is theory, cash is reality. Remember that you can have a profitable business, but still be broke. That profit doesn't always translate into cash. Having information and the right information is mission critical. You can't do it without that. And if nothing else, remember, cash is king. Really appreciate everybody coming out for today's webinar and hope to see you next time. Have a great day.